Okay. What I'd like to talk about today is really, I guess, the current situation in terms of the crisis, where we are, where we're likely to go, and what are some of the opportunities that we need to be thinking about? What are some of the topics we need to be thinking about now for the future in order to make this this particular situation work for us? But I have to say, and I said it yesterday, I'll repeat myself to the other group. I mentioned that my caveat is that I'm an optimist. And right now, that's a very dangerous thing to be, I have to tell you. It certainly puts me in the minority, and maybe it's pathological. I don't know. I haven't been psychoanalyzed, but I think in some way, being an optimist right now is not the most sort of mainstream thing to be. But I am an optimist, and I'm looking at the current situation from that perspective. So I just want to begin by saying, look at how many different analyses people have made over just the course of a year as to the extent of the problem that we're facing. From July 2007, Ben Bernanke said it was a $50 to $100 billion problem. And now he's saying, Paulson and Bernanke are saying it's a $700 billion problem in terms of the subprime issue. We've had all kinds of estimates with respect to how big the derivatives problem is. Do we have a $300 trillion problem, a $100 trillion problem, a $50 trillion? What's the relationship between the nominal value of these derivatives and the actual risk that's out there? And the answer is that we really don't know. We really don't know the full extent of the problem that we are facing. But I can tell you this, that if you look at what the analysts are saying about the extent of the problem, the tendency is certainly to accentuate the negative. And I'll just give you a couple of examples. Right now in the U.S., it's the middle of Christmas season. There were all kinds of media reports, there were analyst reports saying that they expected the Christmas sales season, both in terms of web sales and also store sales, to be down significantly, negative numbers. But in fact, it turned out that the first days of the Christmas season were up 7% in store sales and 15% on the web. Now, the same is true in Europe. I mean, if you look at the results of the retailers, again, the Carrefour is up, and many of the other stores are also up. There has been a tendency in looking at this particular problem to look at it from a negative perspective. Now, some of this is just the difficulty that we have in terms of forecasting and making forecasts. And I know from my own experience, when I was a graduate student, and we did, I worked on my first forecast, and we had this great big model that at the time, I think we were using punch cards and so forth to get this computer model to work. We modeled the energy situation in the U.S. and its impact on the U.S. economy. This was in the late 70s. And we modeled energy prices at $40 a barrel, $50 a barrel, $60, all the way to $100 a barrel to look at the devastating impact on the U.S. economy. And of course, the reality was that oil prices fell to $10 a barrel, and that was the one assumption we did not have in our model. So I learned from that. And the assumptions that we are looking at with respect to this crisis really are what we are going to be acting on. So if we think about what Chris had mentioned, which is that the context is the determinant of how we evolve, how capitalism evolves, we have to make certain that what we're looking at is the true context. And my perception is that we're probably not doing that. Now, right now, if we look at the extent of this problem around the world, we are putting enormous amounts of resources against it. In the U.S. already, if you count up all the bailout programs, if you look at the direct lending programs, if you look at the guarantees, and if you look at all the credit enhancements that are out there, it adds up right now, and we don't know what's going to be added to this over the next few days, particularly with respect to Detroit and its pleas for being bailed out and whoever else is behind Detroit. We have $7.3 trillion allocated to the rescue of the U.S. economy and global economy. In Europe and in Asia, China's big movements over the last few days, we have $2 trillion, probably more, allocated. So we have almost $10 trillion allocated to fixing this problem that at present we're not exactly sure of its extent. We know it's big, we know it hurts, we know we feel bad about it, but we don't know exactly how big it is. So in terms of the environment, there's a piece missing. We just don't have an accurate assessment of that environment. Now, one of the things that people have been talking about a lot is, my God, this is another 1930s situation. We could be on the brink of another Great Depression worldwide. We could see huge problems looming for industry. And we hear that, by the way, from most of the people going for the bailouts, talking about just how bad things can get. But if you look at the statistics, and I put this together, and I have to say, anytime you get into, and some of the other economists here know the problems when you're working with purchasing power parity. I tried to put this together in a way that made sense. It may make sense, it may not make sense, but I think it's a fairly good indicator based on purchasing power, the difference between the economy of the 1930s that we were involved in and the economy today. And if you look at this, you see that, and again, this is on purchasing power parity, so we're talking about the actual purchasing power of individuals. In Western Europe at the time, it was $3,500 a year. That was it. Adjusting now $1990 to make it roughly equivalent, it's $32,700. So we're talking about more than a tenfold difference in the size of purchasing power on a per capita basis in Europe now versus the 1930s. If you look at Spain, it's more than 10 times. We had $2,620 purchasing power in the 1930 period, and we have $33,600 now. So we are talking about a world economy that is so much larger. On an individual basis, it's 10 times larger than now, than it was in the 30s. We have $1,300 purchasing power parity per capita globally in the 1930s. Now it's about $10,000 per capita, but we have a lot more people. So the size of the economy, and it shouldn't say nominal, it should actually say PPP there. But if you look at the difference in terms of the economy, we had a $2.3 trillion economy in the 1930s. We have a $56 trillion economy now, more than a 20-fold difference in size. Now this tells me that people who are making these comparisons between the past and the present are really talking about things that are irrelevant, that are incredibly wrong. The complexity that goes with a $56 trillion economy is so much more than the complexity that goes with a $2.3 trillion economy. And not only that, what we know in terms of knowledge, in terms of human capital, in terms of shared expertise, in terms of how we sit down and dialogue with each other about these problems, there is no equivalent. In the 1930s, what people did was they sat down and they said, let's take care of our own country, let's make certain that we're protected, and forget about the rest of the world because the rest of the world doesn't matter. And as a result, we were on the brink. And we had catastrophes as a result. But we've learned since then, and you can't unlearn the past. You can't simply say that what we have learned is irrelevant in terms of fixing this problem. What we've learned over the last 70 plus years, is an enormous amount of how to work together, how to cooperate, how to coordinate policies, and certainly how to grow together. So I think it's really fallacious to have people talk about the past as if it were the present and to make those comparisons. If you look at the 1930s and you see what a period of deep contraction it is, again, it's irrelevant compared to today. Look at the size in 1930. We had 8.6% decline, 6.4%, 13% on an annual basis in terms of contraction of the global economy. We don't have that kind of catastrophic situation today. We have a very, very different set of circumstances, and I think our toolbox as a result is significantly greater, much more capable, and that's one of the reasons why I'm so optimistic in terms of our ability to confront, overcome, and defeat this crisis. If you compare it to the 1980s, when we also had problems, we had the aftermath of the 1974 meltdown, the big bear market, we had high oil prices at that period as well, and you look at the difference between then and now, again, there's no comparison. In the 1980s in the U.S., the prime rate was 20%, early 80s. Now it's 4%. Inflation rate was almost 15%. Now in the U.S. it's 3% and going down. Inflation worldwide is going down, and I'll get into that in a minute. The jobless rate in the U.S. in the 1980s, 10%, almost 11%. Right now it's 6.5%. It's below in the U.S. The long-term average in Europe. So we are talking about a difficult situation, a situation that requires our intelligence and our coordination and our ability to work together and our thoughtfulness and all the experience that we have in order to solve the problem. But it's not the kind of catastrophe, if you ask me, that we have successfully dealt with in the past. And according to the IMF, we will have one period of subpar growth as a result of these problems if their forecasts are correct. And we don't know whether their forecasts are correct. We'll have one period of subpar growth, but it will still be growth on a global basis. And growth heals a lot of problems. So I think we have to keep these things in mind. Now, we have gotten also some great benefits that have helped us and will help us confront the problems. The first issue that we are dealing with is a collapse in oil prices. Now, that's not good if you're producing oil. On the other hand, most of the world is a consumer of oil. So if you look at where oil prices are today, they're actually even below this chart here. It closed yesterday in the mid-40s. And I have to brag here because I went last year to Congress in the U.S. to testify about where oil prices would be. And I said this was a year ago, when they were about $110, I said that they would hit 60 before they would hit 160, and that we would have a period of low oil prices. And we have to protect against low oil prices. In some ways, it's more important to protect against those if we want to shift toward alternatives to oil. And in fact, that's what happened. The supply and demand equations for oil just did not support prices at 145, which was the top. There were lots of issues with regard to the world's nervousness. We still don't know fully how some of these new products for speculation in these markets worked. We haven't unwound those. There's a lot of debate as to whether or not speculation kept those prices higher than they would have ordinarily have been. But the main point is that oil prices have fallen precipitously, and we're getting a big benefit as a result. In the U.S., the falling oil prices mean gasoline prices have fallen, and almost without any kind of lag time. And the tax situation in the U.S. is a lot different from in Europe. The tax prices are a lot lower. So if you look at what the prices of gasoline are in the U.S., they have gone to below $2 a gallon. Now, for the long-term health of the planet, this is not a good thing. But for the short-term recovery of this global economy, this is putting a lot of money back into people's pockets. It's part of the reason why we have retail sales that far exceed expectations and the analysts' reports. And we have this around the world. Part of that is simply the fact that gasoline prices, oil prices have fallen. In terms of looking at what this means, the U.S. is by far the largest consumer of oil, 20 million barrels a day. It imports 12 million barrels a day. If you look from the high point in July at 145 a barrel, the U.S. is saving almost $2 billion a day. That's going into consumption again. It's going back into people's pockets, and it's also, by the way, going into savings. So we're talking about a very significant increase in disposable income in the U.S. We're also talking about a better situation on the balance of payments side. So the U.S., that should be billion, U.S. is importing almost $1.2 billion a day less in terms of oil. So there is a very significant change that's going on here. And if you look at this on a global basis, essentially this collapse in oil prices is a $2 billion a day stimulus to the U.S. and tens of billions of dollars a day to the world economy. Now, global commodity prices in general are falling. The entire structure of the commodity situation has gone down 50%. This is another significant benefit in terms of how we get out of this predicament. If you look at it and you say, sorry to have an AIG chart up here, given all of their problems, but they still do keep some statistics, maybe all they do going forward. But if you look at this, you see that the index was at 220. It's down at a little over 120 now. It's almost a 50% drop in the index of all commodities. I think the only exception is barley, which has gone up. And of course, we don't know why that is. I don't know if anyone here consumes barley, but that's about the only exception to what is... beer. Okay, there you go. Well, there you go, because actually beer consumption has gone up during this period, so that would explain the barley phenomenon, or the barley exception. So we're seeing very significant issue. Even electricity. Now, this is one region of the U.S. Thanks to cheap natural gas. Natural gas has fallen globally by about 50%. It was $13 and some cents per million cubic feet. It's about $6 now per million cubic feet. So we're talking about a very significant fall in natural gas. That's translated into a fall in electricity of 57.1%. So we're talking about input costs globally having gone down significantly for every country in the world and for almost every sector. This is a very significant boost that an integrated global economy is getting from the fact that we're so closely connected. There is almost no lag. That's the amazing thing about the the way the economy works now, because inventories essentially are cut down to the minimum. We have almost no lag in terms of price cuts and input prices for industry. So we are seeing some significant shifts. Now, taken all together, if you add it up on an annual basis, we're talking about essentially $1 trillion stimulus to the rich countries of the world. And I'm putting China in the rich category, and obviously there's debate, but on a purchasing power parity basis, on the size of its economy and so forth, it belongs in the rich country category. And it's getting a very significant boost as a result of these falling commodity prices. And this is usually ignored. Many people think commodities are boring, and so they don't like to pay attention to them. But in fact, they are the basic inputs of how we work in the real economy, but they also touch very deeply the financial economy. And they are very much in both categories. So we've also started to see lending picking up. This is the U.S., but it's relevant globally. We're seeing there is a credit crunch. There is not a capital crunch, however. There is plenty of capital out there. There is not that much credit that is being lent, but in the U.S., this is consumer lending. It's up to $2.6 trillion, which is an all-time high. And if you look at that little spike at the top, that's October, and you see that, in fact, lending is picking up. Europe is a little bit slower. Asia is slower still. But we're starting to see pickup in terms of the global economy. And this makes me think, at least, that we ought to be thinking about after the crisis. Because these are significant changes. They're not recorded in the media. I say that as a veteran of the media, an alumnus, I guess is a better term, of the media. For some reason, the news is negative about this. Of course, in my day, we only publish positive news. But right now, all the negative news that's out there is not telling you this, which the statistics are showing. The same is true with commercial lending, and this is, again, the U.S. It really has been disrupted a bit, but if you look at the shape of that curve, it's actually a very small amount that commercial lending has been disrupted in the U.S. Now, again, it varies by region, but there is lending going on. Certainly there's lending going on in Europe. There's a lot of mistrust between banks. Interbank lending is not what it was. There's a lot of lending that is taking place through central banks and so forth, substitute mechanism. But these are tools that we're using before confidence returns. So, again, this is U.S. unemployment rates. And if you go back to the 1930s, you see it was at 25.6% at its height. It's now 6.5%. It almost makes you embarrassed if you've ever said this could be another 1930s situation. The circumstances are so different with respect to the statistics. And in fact, if you look at where the U.S. is, it's really not outside of historic norms. And we're talking about situation of 6.5%, which a decade ago or so was really more or less the norm. So we've gotten more efficient as an economy, better at our use of capital, better at our use of inputs, much better at inventory control, incredibly good at our investments and so forth. We have a crisis, but it's not the end of the world. So why does it feel so bad? This is what I really want to know, because I feel bad. No, just kidding. I actually look at this and I think almost everyone I know feels bad. So why is that? Well, the real reason, I think, is just the fact that we feel so out of control. I mean, no one really saw this coming. There were a few people, some of the guys who had developed these securitization products at the beginning, like Lou Ranieri, who was at Solomon Brothers and designed the securitization of these mortgages. He was worried. He came to one of our Milken Institute conferences and he said, we're going to have some problems looming. This was 2 years ago, and he said at the same time, the covenants which bind together these mortgages in the pools are not written so that we can blast them open, take out the bad ones, and rejigger the pools so that if there's a problem, we can fix it easily. He saw it coming. He was one of the few. But aside from Lou and some others, really very few people saw this. We felt that the good times would last forever, that up was the only direction. I think that's a disease that we suffer easily. We had that same feeling during the internet bubble, and we've had it frequently over in the post-war period. But it also looked like no one was in charge, and there's certainly no place to hide. And one of the reasons is the integration of these markets have made it so that everyone has been really affected in the same way. It doesn't matter whether they're in a protected zone with very tough regulations and rules. Spain has an incredibly strong regulatory presence with respect to the mortgage markets and how mortgages are regulated, and yet Spain was hurt, particularly in the same areas. Lending has been curtailed, same set of issues in Spain as in any country. So there's no place to hide. We all have seen the incentives. We've seen how CEOs have gotten on their private jets, flown to Washington, asked for bailouts while their planes idle at the airport, so probably with the engine still on. And we're thinking, what in the world is wrong with these people? That they don't even have a sense from a PR perspective to either drive the Prius or take the train or somehow go on a low-cost airline. I mean, what in the world is wrong? So we think about the incentives where many of the bankers have gotten very significant pay packages as their institutions have melted down. AIG was sending people on junkets for golf and recreation as they were taking money from the government. So the incentives that are constructed essentially have been constructed to have us all walk off the cliff. And I think we see it. And that's been very disturbing because we see it, even if we're investors, we see it, and we have seem to have no control over it. We also have seen that the gurus, like Alan Greenspan, who people had a lot of faith in, and then Alan Greenspan testified before Congress, and he said, yeah, I guess I was wrong. I guess derivatives really were a danger. Well, he's only talking about something between $50 and $700 trillion of danger there that he missed. And he's certainly one of the gurus in this. He's certainly one of the people that gave confidence to the world, mostly because we couldn't understand what he was talking about when he was testifying. But for the most part, that the idea of someone understanding the full extent was really destroyed during this situation. The professional advice was incorrect. It turns out it was very facile. There was a lot of lack of individual integrity, and there was a failure to admit the unknowns. So I think when we looked at this situation and we were trying to parse it out, we didn't admit that there were lots of things we didn't understand with complex products, with the way in which risk was shared and distributed. So in short, many people feel that the promise of capitalism itself was betrayed. And I think that's not an unfair characterization, because in many ways this failure was a failure across the board. It was a failure of investors. It was a failure of regulators. It was a failure of rating agencies. It was across the board. And we didn't see it. So if you look at this, and I'm trying to look now at the near-term future to kind of set the stage a little bit for the rest of the discussions, I think that there are a lot of things to look at. And one of the issues is, what are the casualties of this crisis? Because that's what we're going to build the new capitalism out of, are the new environment that we find ourselves in. And one of the things that we know and we're feeling is that the idea of a national market is gone. The global financial system is linked, and no one is protected. That's how it feels. That's the way it looks. We also have realized that portfolio theory, which is the basis of how we have managed risk, really didn't work. We've had portfolio theory. People are looking at the betas of their portfolio. They're creating mutual funds based on how all of these different betas and alphas and so forth go together in a seamless package. They're globalizing their portfolios. And in fact, the risk takers and the prudent risk-averse people were hurt just the same. And in fact, there was no difference between the people with the high-risk portfolio and the low-risk portfolio. Overall, when we finally do the analysis, I think what we'll see is, in fact, the losses were about the same. So modern risk management practice, that's a casualty here. And in fact, the issue is the black swan idea, which is that you don't think there are any black swans in the world. You think all swans are white until you take a trip to Australia for the first time and you see a black swan. Suddenly, the whole world changes out of that perception. That's a risk that no one forecast. That was an event no one saw. And in fact, because of the way the systems work, those really are the only risks that we have to worry about, are the ones we can't see. And that's what we're not prepared at the present time to really address. So I think we're at the end of the Washington Consensus. And I'll just talk about the difference between the old view and the new view, if you ask me. The old view was that government should not meddle in the private sector, and the new view is essentially that the French system, and who would have thought in the competition between capitalisms, where we had the Anglo-Saxons arguing with the French back and forth about whose form of capitalism was better, that in fact the French system won. We have a capitalism now. It doesn't matter which capital you go to. New York for the U.S. in terms of the capital markets, or Washington or London or Paris. Intervention is the way it's working. Governments are taking shares. This could be dangerous in the long run, especially if you have an Anglo-Saxon perspective. It could be dangerous in the long run. We don't know. We know that there are some casualties from it, and I'll go into those. So, but what we didn't expect is that in this competition, the French system of intervention, of government regulation, of picking winners in the markets, whether it's the big three automakers in the U.S. or other types of industry, we didn't expect that would essentially be the victor in this particular crisis. Government and the economy don't mix. That was the old view. Government is the crisis manager, is the new view. We're not sure, by the way, whether the government has all the tools to be that crisis manager. Has the knowledge, but are the tools there? That's what we have to assess. And what were the purpose of the rules? In the old system, the Washington Consensus, the rules were there to create a level playing field. But now the rules are there to manage risks. That's a very different use of the rules. The government in the past shouldn't pick winners. Well, every country is picking winners. whether it's particular mortgage firms in the UK that are going to persist and continue to exist and get bailouts, or whether they're insurance companies in the U.S., or whether they're automakers around the world. We're picking winners now. And the worries. Well, in the past we were worried about the rapaciousness of cowboy capitalism. Now, what we know is that, and what we're worried about, is slower growth. Because one thing that happens as a result, if you compare, say, job creation, well, in the so-called French system, job creation is not as robust as it is in the Anglo-Saxon system, and that we have a lot of data about that. So job creation could be a casualty. So what is capitalism now? It's anything we say it is. It's up for grabs. The whole definition of capitalism right now is up for grabs. And we can define it right here over the next 2 days, or we can let the politicians do it. But it's going to be redefined into something different. Now, one thing we do know is that government role as a spender in the economy is going to increase. This is through 2008 through and if you look at the U.S. here, we're talking about a 33% role of government in the U.S. economy. It's higher in Europe. We pay a penalty for that. We do get stability. This is sort of the thesis of Hyman Minsky in his work on Can It Happen Again about a Great Depression. His argument is that the greater the role of the government in the economy, the less chance we have of a depression happening again. The problem is that the governmental expenditures, which are regular, which continue, which are political, are also not high growth factors in the global economy. So countries that have large shares of government in their economy are stable, but they're not quickly growing, and we need to have something of both. Now, here is something that I think is remarkable and I think it's a harbinger of what the new kind of capitalism is going to look like. First of all, China had $1 trillion investment in U.S. mortgages. The Treasury bailed out Fannie Mae and Freddie Mac largely to protect that Chinese investment in mortgages. China reciprocated by lowering its interest rates. This is a watershed in terms of economic and financial cooperation between China and the U.S. And we have not seen this in the past to such a high degree, but we saw that it was a relationship that works. We had a stimulus, a response. We had a good outcome from that. We also have seen the U.S., UK, EU, Canada, Swiss, Japanese, Chinese, all lowering interest rates on the same day. We'll see it again today in Europe. And we've seen a lot of divergence in the past on this. Now, there is still argument, and Europe is going in one way, UK in another, and US in still another way on how much to lower, but there's no debate about lowering interest rates. There's no debate about what's more important, inflation or growth. That is agreed upon in a way that we have not seen in the past. We've also seen that actions that look better, such as the way the UK approached its bailout, have been adopted almost overnight by the U.S. There's not the grandstanding, there's not the unilateralism, there's not the cowboy mentality. Texas ideas are going away to be replaced now by new ideas, and in fact, coordination is happening. So I think one of the harbingers of the new form of capitalism that is emerging is that we're talking about global harmonization, working together, And this is going to happen, I think, with the accounting agency and rating agencies to begin with. Now, I can tell you, when I was a journalist in 1987, when we had the collapse of the stock market in New York, then around the world, and it was a catastrophe in terms of the degree to which wealth was destroyed on that one day in 1987. I talked to John Phelan and I talked to some of the others in the U.S. and I asked them, he was the head of the stock exchange, I asked him, is he calling his counterparts in Europe? And he said, no, why should I? They know what's happening. Now, that attitude of 21 years ago is completely different. They're all in contact with each other. They're all looking, for example, at the Japanese situation and learning from it. They're discussing it. They're sitting down. And they're on the phone, on video conferences. The whole world, in terms of the capital markets, is integrated right now and working together as we have never seen in the past. So here's one of the most egregious issues, and this is why I say that this is where I think coordination will begin. If you look at the failure of the rating agencies in the U.S., and you see that this is 2007, these are the number of securitizations in the U.S., 1,295. 45% of those securitizations were rated AAA. Now, there are about a dozen AAA-rated companies in the U.S., but the regulators somehow saw fit to rate 45% of these security portfolios as AAA. And if you peel them back and you look at them and you see what's actually inside those portfolios, they get worse and worse and worse. And it's a very, very troubling story. So I think we're going to start seeing some type of mechanism created where we can discuss this. So what can we expect? Well, I think we can expect persistent volatility, at least for the short term. What's interesting about this economy that we're in is that since World War II, the end of World War II, we have seen volatility in the capital markets globally increase on a very consistent basis. And to the point now where we're seeing 6, sometimes higher, rises and falls in various markets in a single day. But what we've also seen is a decline in the number of recessions during that same period per decade. So we don't know what the relationship is exactly, but we know that the capital markets are maybe functioning as shock absorbers, with that volatility absorbing what would have been a recession. So we're down. We had 2001 was an anomaly because of the issues in New York, but we're essentially down to one recession per decade. We did have in the 50s 2 and sometimes 3 during that period, and in the 60s and so forth. So we are seeing much more volatility, much fewer recessions. So increased collaboration, and we're also seeing what I think is just a wonderful development in the world, which is the full integration of China into the G20, not as a second-class partner, but as a co-leader with the other members. This is a very significant step forward. So I'm just going to finish up here. We've had globalization in the past, but it's been spotty. We had a good globalization of processes. We can manufacture around the world very well. Logistics, payment systems, these all work. We've had a fair globalization of information, such as market data, but only fair. We've had actually a very poor globalization of rules, laws, and regulations. And then we've had almost no globalization of risk management, almost none. So this is just reiterating that rates are starting to come down, and that what we will see is that capital as it is becoming available, will seek returns, that buyers are beginning to emerge. As I mentioned before, we have a credit crunch, but we don't have a capital crunch. There are trillions of dollars on the sidelines in money markets and bank deposits that are waiting to get in there. Merrill Lynch, having sold $8 billion in mortgages at 22 cents on the dollar. This is very attractive. Lots of investors are looking at that. They're waiting. But as I've said, no one rings a bell to let you know we've hit the bottom. There's no signal. For Warren Buffett, the bell rang in October. He started buying. He's trying to buy, over the last couple of days, Constellation Energy. So for him, the bell already went off. Other people are waiting, but in fact, we're probably pretty close. This is just some, which we don't have to go into, but here's something that I want to point out because it's quite important. This is the distribution of credit scores in the U.S. And if you look at this, you see that from 600 up, which designates fair to good credit, we're talking about, I think it's 73% of the U.S. population has fair to good credit. So the underlying fundamentals in many ways, in terms of people paying back their mortgages, consistently servicing those mortgages and so forth, is actually not catastrophic. It's exaggerated in terms of the negative. Here are some of the capital reserves. We have plenty of capital. Some of it is in this room, I've noticed. So we have plenty of capital that is ready to invest. I don't think derivatives will go away. They do serve a very important purpose, but I don't believe we can afford, nor will we be willing, to rely on self-regulation for derivatives. We will go to a market system and that will be one of the hallmarks of the new capitalism. So again, this is a time of unprecedented opportunity. No one rings a bell to let you know that we're at the end. We need to lobby for sensible rules and regulation because the tendency is going to be punitive, and that will accomplish nothing. We need to create real forums for coordination. We need to actually understand that there are enormous new niches that are going to be created. Some of these may be the recreation of old-type partnership firms in investment banking, now that we've lost most of the investment banking industry. We're going to see new businesses emerge, and we have the opportunity to look at the whole issue of stakeholders in a fresh way, rather than simply say stakeholders as we do in the Anglo-Saxon market world, that the stakeholders are the same and identical with shareholders. We can look at this equation differently. We can redefine it. Thank you.